Welcome to CEO Money. I'm Michael Yorba. I have Keith Schneider, Marketgauge, on the show with me today. All right, Keith, welcome to the show. Glad you're here.
Thank you for having us, and good to be here.
All right, now I read your latest view of the marketplace, the destabilizing linchpins of the market, and I see that there is I really wanted you to come on the show because as soon as possible after I read this, because there are some real strong points you make in this letter that I think need to come out. You have a global macro view. There are 5 key relationships that you look at to get a view of the big picture. But before we break into all of those, I want to bring out this part in the newsletter that really struck home to me, because when certain events occur, sometimes they supersede a lot of other things that you and I have grown to know to adhere to with our trading rules, with technical, and sometimes there are overriding fundamentals that just outweigh. And that was this business about Venezuela asking the Bank of England to return 14 tons of its gold reserves, and then, to me, using a veiled excuse of the United States to not be able to scramble and gather their gold and deliver it. Give me some insight on the micro-macro fallout if these guys don't deliver the gold that Venezuela says we own.
Well, yeah. I mean, the thing is this: there's the way gold and the storage of gold and the gold reserves have been handled in the past. It's sort of a sacred situation where central banks will hold gold for other countries, specifically the Federal Reserve, the Bank of England. This is sort of the linchpin of how the banking reserves, certainly the gold reserves of the central banks, operate. And political considerations are not supposed to be factored in. I mean, there's no question that Venezuela owns its gold, and it's obviously in a dire situation. It needs gold to pay for food and basic things at the moment. Now, you can't argue that their economy has not exactly been well managed, but that's separate. It's their gold. So, in essence, if they can't get their gold because of political sanctions, then the whole idea of their gold, of any country's gold reserves being held in a foreign bank for both trade purposes and also security. I mean, there's been a lot of gold held, let's say, by Germany in the U.S. and in England because it was afraid of Russia over the last 50 years since the Cold War started. So all of the gold reserves have been diversified. So a country doesn't want its bank reserves confiscated by a foreign power and then, game over. So in this case, it's almost like that happening. Now, if that happens, it could trigger more repatriation. And so a lot of the gold is basically collateralized. There's been a lot of rumors about the fact that the physical gold in these central banks are not really being recorded properly. And that's always been dismissed by mainstream press. It's hard to know what the truth is. But put it this way, if you're talking about a potential catalyst of this type of thing spreading, this could definitely be the event that does it, right? If you're concerned that the United States and the current administrations is placing sanctions and you can't get to what is rightfully yours as a country, you're going to want to repatriate it back home. And that could mean all of the cross-collateralization gets called. So right now, everything is sort of status quo. 14 tons of gold is a lot. It's, I don't know, like $500 million, but it's not a huge amount. So with that, this could, like you are asking, could be a catalyst for a run on gold. So far, it's not happened, right? If you look at the gold market, if anything, you could look at it right now and say, with the way the market's been under pressure, how come there hasn't been a bigger run on it at the moment? Now, we sort of bottomed over the last couple of days. And what's interesting, with the sell-off in the equities market, our key intermarket relationship of looking at gold versus the S&P has flipped into what I call risk-off zone, right? So all of a sudden, over the last 30 days or so, gold now is outperforming the S&P. So even with quite a number of the sell-offs recently, that gold had been sort of really dormant and even underperforming the S&P, even as they were both going down. That has switched. So you put these two things together, it's interesting. You could have this unusual catalyst happen, but it has to play out.
I understand and I agree with you on that. The question, I'm looking at gold right now on my trading platform, and I'm wondering if we have nothing more than a secondary accumulation pattern occurring. First one being from August, middle of August till, October, and now it's from the middle of October through now. It's at a higher level, but it seems to me just to be going sideways, then it gaps up a little bit. So it's almost like two connected accumulation patterns in gold.
Yes, I think if you want to just keep it simple,
yes,
the best way to look at this is if, in fact, there's something going on, or let's say there's two things that can happen. That obviously this whole issue with Venezuela it could flare up, but it most likely will also coincide with further destabilizing of equities and money going into gold. And I think that's going to occur somewhere above the 118 level in GLD.
Okay.
If you take a look at that, that would clean out all the noise. In fact, you would sort of have, from a technical trading pattern, a head and shoulders bottom pattern. And we also like to look at seasonals. And there's something that we call our calendar range. So the 6-month calendar range would be violated as well if we get above that 117.50 to 118 level. And that would tell you that something is really underway.
Okay. Noted. Let me ask you about a couple other of your indicators, one of which, two of which right now I've never seen before in my life. Lumber and gold, how you've got that ratio, and the other is inflation and anxiety. Let's start with the lumber and the gold ratio. I'd like to better understand how you use that, what it's telling you now.
Well, gold, of course, is often a safe haven during geopolitical crisis. I cut my teeth on the floor of the New York commodity exchanges in the mid to late 70s. And that was the hunt corner of silver and the run up of gold from, the 300 level to 850 in a very short period of time. Mm-hmm. And that was based on oil, a lot of oil money after the OPEC embargoes of the West occurred, and a lot of the money they made, because oil tripled in price like twice during that decade. So in essence, a lot of petrodollars were recycled into gold, and that really caused a major run. And it was not really good for the overall economy. So what I like to do is look at gold moving up, because it can move up because of inflation, and you can have a stock market that goes up along with gold. So, gold is sort of like a chameleon. It could do terribly along with the equities market, run up, directly with the equities market, depending on the scenario, or completely diverge as sort of an alternative play or an anxiety index. And one way to gauge that is looking at lumber. If it's pure inflation and not anxiety, lumber will outperform gold, and that's telling you the economy's probably good, construction's doing well, you have inflation picking up, and gold is underperforming lumber. On the other hand, when gold is outperforming lumber, that's telling you that there's some anxiety out there. So I look at that as a good filter for understanding what's happening in the gold market and what that's telling us about the global economy.
So measuring this roughly from my trying to understand what you're just saying, we had lumber at 648 and then ran down to and let's get a time frame on this, back in May, middle of May, to a low of 299 here at the near the end of October. That's almost a 50%, a little bit better than 50% reduction in value in a very short period of time relative to gold giving us a bottom. And really, there's no been dramatic up or dramatic down in gold, just kind of making a rounded bottom, if you will. What does that tell you?
It's telling you right now that there is, off of that ratio, that there's quite a bit of anxiety in the markets right now. So gold has been firming, obviously housing, lumber, and there's pressure on the economy. So much like in 2006, 2007, lumber is extremely sensitive to the housing market. And, housing stocks have just gotten totally pummeled. Again, yet another way of looking at just the housing market as well.
But looking forward, let me jump in there. Looking forward the next 2 quarters, which are going to have to be, we're going to see the results of this. Futures work, they're way ahead of the reports that we get. Does that tell me that we may have a real rough start to next year in this industry?
That's what I'm thinking right now. Absolutely. And, it's unusual because generally speaking, this is the time of year that, markets are supposed to be running up. And they're not. Well, not only they're under tremendous pressure here. Mm-hmm. So what was interesting also when you talk about our risk gauges and those 5 key intermarket relationships is, as the market moved up after the midterm elections, that big move up, within 1 or 2 days, all those risk gauges started giving up all the gains and moved into either neutral or negative territory rather quickly. So that was interesting read to give you a heads up about the pressure on the markets at the moment.
You've got some great forward-looking momentum indicators, the proprietary momentum indicators. What are they telling you now?
Well, listen, the basic concept is that momentum precedes price. Right. So now the tricky part is, depending on the type of time frame you're looking at, it could range from immediate gratification to it takes a year or more. So at the moment, I know a lot of people who are looking at the weekly charts on pure price movement and just looking at the moving averages, let's say multiple moving averages, and they're looking for them to start rolling over. They're sort of iffy. But if you look at the derivative, which is momentum, it's really showing tremendous weakness at the moment. So even though the market made new highs in October, right, or late September, the momentum clearly failed to make new highs by wide margins. So in essence, we've got tremendous momentum divergence across the board. So, and we actually have breakdowns. So I like to look at like a 3-year moving average of the momentum or a 4-year. And in all of our key indices, we've basically had massive divergence and are now trading under key momentum, the moving average of the momentum, and that is not a good sign. So momentum on weekly charts and daily charts have broken down.
Is there any indication of a change in trend at this point, or is it still, same day, same story?
I would say that we're getting indications that the trend is now breaking. So what I like to do is look at my momentum indicators and see what the price action is for the confirmation of timing. At the moment now, especially with today's action, all of our weekly charts looking at an annual, let's say, moving average for phase we're trading across the board under our 50-week or annual moving average. So that is already breaking down.
Okay, so what I meant was on your momentum indicators, the trend is still in place, lower.
Lower. The trend is lower now.
Okay, all right. So now it's a solid. Now it's all about where the turns will be, where the bounces will be, and how do you manage the trade, since it looks like it may be in place for a little while. I've had some people say this could go on for at least 2 years. I have people that got really out there and say longer. But at this point, that's long enough to trade. And if you've got the heads up, which you should have by the people listening to what you've been telling them, the timing has been impeccable since I've known you and been on the show. This is enough information for people to start to wake up and to be able to at least protect the principal and create alpha by using the tools they've made available in your timing models.
Absolutely. I mean, this is definitely giving you a heads up. If you're a passive investor, I wouldn't be so passive. These are definite, and also when markets go counter to its seasonal trends, I'd be really concerned. At this point, if you look at the stats, midterm elections going back to the 40s, we've had, I think, 18 of them. All 18 have resulted in really strong rallies, starting after the midterms. That's not what's happened here. So I would be definitely saying that this is not the norm. And when it's not the norm, I get really concerned as well. So, that was no different than looking at, historically unusual events. And, looking at black swan events is sort of what I grew up on. When I went down on the floor, and I was the youngest member of the New York Mercantile Exchange at 20, that was during the period that gold and silver took its meteoric rise. And I saw people who had substantial, money go broke. So that has always stayed with me, and especially unusual events. And in fact, I would say from a personal approach, I like to take advantage of outliers rather than invest along with some mean reversion. I try to look for things that are not going to mean revert. And at this point, I'm looking at the market here saying there are signs here. It's not fully in yet, but there are signs, including the momentum and some of these other risk indicators, specifically, going to the next one, which is looking at high yield debt versus bonds, is also telling you that there's some problems in the credit markets. Now, I'm not the first one to say it. Ray Dalio, by the way, who I used to have adjoining office with. So I used to get his reports back in 1987 before the market crash, and it was a very, very interesting, different perspective than how we do it, but he definitely saw that coming, and he is also laying out warnings now about, number one, the credit cycle, right? 35, 40 years of downward interest rates, putting pressure on the market, and of course, the problem with us repaying our debt down the road. These are big issues. We're starting to see signs of it at the moment with high yield debt definitely losing steam relative to the safety of U.S. treasuries. So there's some trouble if you look at that key ratio as well. High yield debt versus U.S. treasuries, 20 years.
Great. All right. Keith, thanks for being a guest on the show. I'm glad we've had this chat. This is the first chat that we've had with each other.
Yes.
I look for many more.
Thanks for having me.
My pleasure.
A pleasure. Take care.
All right, you've been watching CEO Money with Michael Yorba and Keith Schneider, Marketgauge. Thanks for watching with us. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.